All right, so before we get started, we have to know what a lien is so we can understand specific liens and how they work and the processes and whatnot. So the definition of a lien is: a lien represents a legal monetary claim held against or placed against a property, personal property or real property, which provides a lien holder security for a debt, obligation, or judgment. So if you owe somebody money, they can come after you to satisfy that debt by placing liens on your personal property like a car or your real property. Two things you have to know: liens are generally enforced by a court order when the creditor actually files legal action. And then number two, a court can order the forced sale of a piece of property to satisfy that debt. And we're going to talk more about that in this video. Now, liens fall in two categories. They are a voluntary lien or involuntary lien. And we're going to discuss in detail both. A voluntary lien is also known as, and you have to know this for your real estate exam, a voluntary lien can also be called an equity lien. An involuntary lien can also be called a statutory lien. Now, a voluntary lien is where there is consent given to place the lien against the property. For example, a deed of trust or a mortgage. So when you go down to the bank to borrow the money, the bank's going to say, listen, I'll give you the money so you can buy this piece of property, but in return, you're going to voluntarily agree to allow us to place a lien against the property in case you default on your payment. That is a voluntary lien. An involuntary lien, or sometimes called a statutory lien, is created by statute or operational law, and it's done without the property owner's consent. That's why it's involuntary. Couple of key terms you have to know. The debtor is known as the lienee, and the lien holder is known as the lienor. All right, so if you borrow money from the bank, you're the debtor, so you're legally known as the lienee, and the bank is the lienor because they're the ones who hold the lien against the piece of property. Examples of involuntary or statutory liens are special assessments, property taxes, child support in some state, including Nebraska, and some others, and we're going to talk about each one in detail. Liens can be specific or general. So we can have a specific voluntary lien, or we can have a specific involuntary lien. We can have a general specific lien or a general involuntary lien. Now, the thing you need to know about specific liens, and that's what we're talking about first, they only affect a singular specific piece of property. All right? So a lien is placed only against a piece of property. These liens can typically force the sale to satisfy a debt. So for example, we talked about that mortgage or that deed of trust. When you borrow money from the bank, if you don't make the payment, then the bank can force the sale of that property to pay off that loan. Property taxes are specific. So obviously, real estate taxes have to be paid, and if you don't pay them, then the property tax is specific to that piece of property, so there's going to be a lien placed against that piece of property. Special assessments, mechanics liens, and attachments. And I'm going to talk more about each one in the next slide, but thing to know, they can be voluntary or involuntary. They only affect a specific piece of property, and there can be a forced sale to satisfy a debt. So let's talk about each one of the type of specific liens that you need to know for your exam. Number one is a mortgage. We already talked about that. Number two, property taxes. How it works, you don't have to really know this for an exam, but I do want to do this for illustrative purposes. In Nebraska, for example, you have to pay taxes twice a year. So if you don't make your property tax, the first Monday of every March, the county is going to sell what's called a tax lien certificate. An investor is going to buy that tax lien certificate, and there's a 14% penalty interest. After a 3-year period, if you do not redeem or pay off that tax lien certificate, including the principal and the penalty interest, then that lien holder can foreclose on the property essentially, and you lose ownership to it. So it is an involuntary lien, meaning you're not consenting to it. It's automatically placed against the property. Special assessments, that's an involuntary lien. Now, special assessments are used to pay for things like improvements such as sidewalks, streets, utilities, street lights, those type of things. And if you recall the past year, there's been some debate here in Omaha about, because we have residents that live within the city limits of Omaha, but yet they still have dirt and gravel roads. And the city says that the owners have to pay for that. So what happens is the city's going to come in, they're going to pave or put the street in, they're going to put concrete in, and then they're going to have a special assessment levied against each one of the residents or each one of the properties that are on that street. And if they don't pay that special assessment as a property owner, then the city can come in and actually foreclose on the property to pay that debt. Number 4, a mechanics liens. That is an involuntary lien. So if you hire a contractor to do work and that contractor buys materials and does the work, so there's labor cost, and then you don't pay them, they file a mechanics lien against that property. Number 5, attachment liens. Now, attachment liens are not very common in residential side of things, but they are actually common in the commercial, specifically the retail industry. So what it is, it's a lien placed against personal property. And remember, another name for personal property is chattel. And it prevents the owner from leaving the state with the merchandise. And what happens is the sheriff, upon receiving the court order, will actually go and seize all of that merchandise. It'll be sold off and then liquidated into cash to pay for that debt. So if you have a retail establishment and you have huge inventory of clothing, for example, that you purchased, well, that's a debt that's owed. If you go out of business, that creditor, that person that financed or gave you all the clothing, is going to get a court order. They're going to have the sheriff go out and confiscate all of that merchandise, all that clothing, and then they're going to sell that to satisfy that debt. That is called an attachment lien. And an attachment lien, key here, is it only attaches to personal property. All right, let's talk about general liens. Remember, liens are specific or general, and they can be voluntary or involuntary as well. And it affects all personal property and all real property. So it's not like a specific lien that's specifically to a singular property. This is relevant to all personal and real property as well. And these liens, like specific liens, can force the sale to satisfy debts. And some examples are federal income tax, judgment liens, federal and state estate tax, inheritance tax, decedent's death, that's somebody that dies and they leave debts behind, child support, and corporation franchise tax. And I do want to talk about each one of these specifically. Now, general liens, here are some types. Federal income tax. This is an involuntary lien. This is if you don't pay your federal income tax, then the IRS places liens not only on your personal property, such as vehicles, but also your real property. And these liens are valid for 10 years. So every 10 years, the IRS has to refile those liens. Number 2, judgment liens. This is an involuntary lien. Give you an example. For those of you old enough to remember the O.J. Simpson murder trial, he was accused of murdering his ex-wife. He won the criminal case, so he was not convicted, but the victims' families, there was 2 people that he allegedly killed, they filed a wrongful death suit in civil court, which is different than criminal court, and they won. They won what's called a wrongful death suit. And I think if I remember correctly, the judgment was like $30 million or whatever. So the 2 families that won the judgment, they went out and placed liens against everything that he owned, personal and real, including his Heisman Trophy. And much of that was collected and sold off to pay for that judgment. Now, one thing you have to know about a judgment lien is specific liens have higher priority over judgment liens. And we learned in a previous video that liens are priority liens, or the priority of the lien is based on first come, first filed. So whoever filed first is senior, then second, then third. Well, what happens with a judgment lien is even if that lien is in first place, a specific lien will automatically jump above it. A tax lien, for example, is going to jump above a judgment lien. An IRS lien is going to jump above it. It has a higher priority even if the judgment lien was filed first. Federal estate tax, this is an involuntary lien. This is where a federal tax is levied against a dead person's estate upon the transfer of property to the devisee. So from a previous video, we discussed how this works. So the devise is the property that's being willed. The devisee is the person receiving that willed property. So upon the transfer of title of that property to the devisee, then federal estate tax has to be paid. And then the estate will have to file an estate income tax return. Number 4, state inheritance tax. It's a lien that's automatically placed against the inherited property until those taxes are paid. Number 5, if a decedent's debts are, so if somebody dies and they have assets and they have debts, well, the creditor can place liens against the estate, the property of the estate, to ensure that they try to get some of their money back. Credit card companies do this typically if they know that the decedent has substantial assets. Child support, that's an involuntary lien in Nebraska. It's automatic. It'll be placed against your your real property. Number 7, corporation franchise tax. This actually is a very old tax law, but the tax is based upon an income that you get from a franchise or a capital stock that's issued by the corporation. That's really all you need to know about that. 2 other liens I need you to know about. Vendor's lien and a vendee's lien. Now, I talked about in a previous video land contracts and what they are and how they work. So you won't understand this principle totally until you go back and watch that video. But a land contract is where the owner sells a piece of property to somebody and it's financed through a land contract. The vendor is the owner. The vendee is the person buying the property and receiving what's called equitable title. The vendor, the owner, retains legal title, and then the vendee gets the equitable title. Now, these liens, the vendor's liens and the vendee's liens, are there to protect both their interests. So, on a vendor's lien, if the vendee, who is the buyer, if they default on their payments and they stop making their payments, it's a way for the vendor to go in and get their property back. The one thing you have to know, the vendee, if they are foreclosed upon, they will lose all their down payment, all their equity, everything that they've paid up to that point. It all goes to the owner or the vendor. On the other hand, if the vendee complies and they fulfill the terms of that land contract, they pay everything off, and the owner or the vendor refuses or fails to transfer a deed, transferring legal title, then it's a way for the vendee to go in and enforce their interest. And it's a way to protect their interest. Municipal liens, this is interesting. It's becoming more and more prominent. Utilities, electrical, water, sewer, gas, those type of liens are placed against the house, not the person. And this is a big issue in the landlord-tenant community. So the tenant goes and has the electrical paid up, hooked up and established on a rental property that they're renting, but they don't make their electric bill payment. So a lien is then placed for that amount against the property. Who ends up paying that? Typically, it's the owner of the property. That's why screening for good tenants is so essential. In those jurisdictions, the municipalities place the lien against the property, not the person. Surety, bail, bond lien. This is if you use your house as collateral to bail somebody out of jail. And then the last one is on your screen, les pendens. that means lawsuit pending. This happens when, there's a lot of ways this happens, but what happens is somebody files a lawsuit against the property and then it prevents the property from being sold. Here's what I'll tell you happens most common in the real estate world. Buyer-seller enter into a contract, the deal blows apart. The seller says, okay, the buyer is not performing, so we're going to put the house back on the market and we're going to find another buyer. The first buyer says, oh, bull crap, we still think we have a valid contract. Seller says, nope, moving on. The seller then enters into a purchase contract with somebody else. The first buyer says, well, I'm not going to allow that to happen. So they go into court and they file a lawsuit against that person. That lawsuit is going to show up on title when a title search is done. And so what's going to happen essentially is if the second buyer is getting financing for the property, the lender's never ever going to loan the property because they can't get free, clear, marketable title. Now, theoretically, if it's a cash deal, that second buyer could still purchase the property, but they're going to purchase that property without getting free, clear, marketable title. And we call that a cloud, C-L-O-U-D. There's a cloud on title. So that second buyer is actually going to receive ownership to that property that is not free and clear of liens and encumbrances. So there's a cloud on the title. A lot of great stuff we talked about today in this video. If you're going to continue studying, check out this video right here. And if you haven't subscribed to the channel, please do so. Click on the little circle to my left. I would appreciate it. I'll see you in the next video.